Hello, everyone. Jeff here with our June market update. And we have special guest Christine from RCN Capital.
Hi, everyone. Great to be here.
Gonna add a ton of content. So glad you made it.
Thanks so much for having me.
And of course, Rick, welcome. How are you?
Doing well, Jeff. Living the dream.
Is it done raining in California? That's all I want to know.
You mean Seattle South?
Exactly.
Yeah, it beautiful, bright, sunshiny day today, right out of the Chamber of Commerce tour guide. So I think the weather is about to turn here in Southern California.
Fair enough. Fair enough. Well, we'll get started so I can get you out to that afternoon surfing session. So, Rick, the Fed meeting yesterday where they indicated we might get one cut on the dot plot. Always difficult to read Chairman Powell and where they go. We always hear data dependent. What did you see coming out of yesterday's meeting?
Yeah, great question, Jeff. I think Chairman Powell at yesterday's meeting was about as transparent as a Fed chair is allowed to get. It does look like if we are going to see a rate cut this year, it will be late in the year, probably at the Fed's December meeting, and we may not even get that one, depending on what inflation does for the balance of the year. There was some good news coming out of the numbers this week. The CPI was actually up by 3.3% year over year, and the expectation was that it would be at 3.4%. So inflation came in a little lower than what most of the experts had been forecasting. That had to be good news for the Fed, who has seen the inflation numbers not behave the way they'd like in several of the months past. But the other news we got out of the Fed, I believe in their commentary yesterday, was that they're looking at sort of a new normal when it comes to inflation of being closer to 2.8% than their previous number of 2.6%. So we may be getting a little bit of a dose of the new reality for the Federal Reserve Board governors and for the rest of the country, in that their expectations for how low inflation is going to get in the next couple of years may have been adjusted upwards just a little bit.
You know, Christine, one of the things that we see with investors all the time is sort of a crystal ball mentality, right? Like investors want to know, you, the expert on the front lines, right. Christine, when are rates coming down? What is happening? And at the end of the day, as Rick said, you know, there's only so much information that we're going to get out of the Federal Reserve.
Right.
How are the customers today sort of talking about rates and either holding back or just diving in?
Well, I think when we try and look at the market from a crystal ball perspective, it's a little bit hard. And when you talk to seasoned investors, they tend to look at things with rose-colored glasses. I wish I had invested more. I wish I hadn't waited so long. I wish I wasn't on the sidelines for these things. You know, the most seasoned investors that we're talking to, no matter what the rates are, they're still going to be jumping into these properties. So if you're standing on the sidelines waiting to see if those rates are going to adjust hugely, they're not going to be making any huge adjustments in the next year. It's not, you know, back to post-pandemic levels where we were seeing really great interest rates. So I think that the time is now to really jump in on any properties that you're able to find. Inventory is still really limited. So, you know, anything that you can find and really scoop up on the inventory side of things is, you know, go for it.
You know, that's a great point, Rick, which is how does the average investor think about what the Fed's going to do? And as Christine said, the time is now, right? Like no matter what the Fed does, it's really not going to move the needle all that much.
You know, it's an old truism, Jeff, that when it comes to real estate transactions, the time is now pretty much all the time. And if you're an investor waiting on the sidelines for market conditions to improve, they very often don't act the way you're expecting them to act. And so you might miss the boat by waiting too long. If we're looking at it from a market perspective, it's highly unlikely we're going to see financing costs go down significantly anytime in the very near future. So if you're an investor and you can make an investment purchase pencil out, whether it's for a fix and flip investment or whether it's for a property that you plan to hold and rent, waiting for better rates probably isn't the right answer. If you're waiting for those better rates, while property values continue to go up, you're going to wind up paying more for the property anyway. And there's a limited inventory of properties available for sale, so there might not be anything left for you to buy. So again, it's not a good market for investors to go in without doing their homework, kind of willy-nilly and just throwing money at everything. But for investors who know what they're doing, can do their homework, do the math, and make the numbers work out, there's still a lot of opportunity out there, both for purchase opportunities and for rental opportunities.
That's a great point about making sure that the numbers pencil out, because while we are starting to see that, some of the home prices are rising, we want to make sure that investors aren't, overestimating what that ARV is going to be on the fix and flips, because we still do need some time for the appraisal market to catch up. And, making sure that those comps really pencil out is going to be really important as we see home prices start to trend up a little bit.
Yeah,
Christine,
that's a good point.
Christine, that's true for both the fix and flip investor and also the rental property investor. If you're looking at making those numbers work on an investment, you need to know what's going on, for example, with rental rates in your market.
Right.
And in a lot of markets across the country, those rates are flat year over year. In a handful of markets, those numbers are actually negative year over year. So if you're buying a property to rent, counting on being able to make it profitable based on rental rates increasing, you need to really know what's going on in your market before you take that plunge.
Right.
It's certainly true in the case of a fix and flip investor who really needs to know what pricing trends are in that investor's market. And there are a handful of markets across the country like Austin, Punta Gorda, Florida, Boise, Idaho, where property values have gone down double digits year over year, in spite of the fact that nationally the numbers, the price increases are positive by 5, 6, maybe 7%. So it really comes down to understanding what's going on in your local market, doing that diligence, and making sure that your investment pencils out.
Right. And on the DSCR side of things too, with, even if the property values are rising, if we're seeing insurance costs increase too, it doesn't matter how much that property is worth, because if the DSCR doesn't check out, you're not going to be able to maximize that value on the property. So, not only the rents, but making sure that you have a really good sense of where the annual insurance premium is going to come in as well is really important.
Great point on the insurance. Rick, insurance, what are you seeing? We're hearing all sorts of trouble in California, Texas, and Florida.
Those are the 3 hot button states when it comes to insurance, Jeff: California, Florida, and Texas. In fact, in the RCN Spring Investor Sentiment Survey, we found that over 90% of investors believe that insurance was either a factor in their decision-making process or the high cost or unavailability of insurance in their market had caused them to miss out on a deal. And if you look at investments specifically in states like Florida and California, there's just about no investors who aren't experiencing some degree of difficulty when it comes to insurance. Texas is the state that doesn't get mentioned as often. It doesn't have the kind of floods that Florida frequently has, doesn't have the kind of wildfires or earthquakes that California has. But it turns out that it is ground zero when it comes to severe hail events. I just saw some published data from a company called Verisk that suggests that insurance claims because of hailstorms last year were up by about 40% in Texas year over year. So we're talking about these severe hail events with hailstones an inch or bigger in diameter, increasing in frequency, but also increasing in the severity of damages.
So I want to go back to the favorite topic of all investors and maybe even all real estate professionals, which is, what does higher for longer really mean for not only the real estate, but the economy in general? And it seems like we've sort of gotten there now, right? Higher for longer seems to be where we're at.
Well, to take a half a step back, Jeff, just to explain what we're talking about to people that are joining the conversation. Typically, the Federal Reserve will raise the Fed funds rate in order to slow the economy down. And they generally do that either because they believe inflation is about to start jumping up, or because inflation has already jumped up and they're trying to get it back down to more normal levels. And typically, this will happen over a fairly short period of time. The the greater the inflation risk, the higher the Fed will raise the Fed funds rate in order to get it under control. And typically, we see the inflation rate start to adjust pretty dramatically, and the Federal Reserve can then start reducing the Fed funds rate appropriately. What's happened this time is inflation is much stickier than it's been in prior cycles. The Fed waited a little longer than usual to start raising the Fed funds rate. And so in order to combat that inflation, they really raised it at unprecedented speed. We saw the Fed funds rate go from 0 to 5.5% in a matter of months, which really has never happened before in history. Once they did that, we started to see inflation come back down, but then it sort of plateaued at a rate slightly higher than what the Federal Reserve was hoping for. And in some months actually ticked up a little bit. And so the Fed has basically decided that rather than increase the Fed funds rate even more, what they're planning to do is maintain their current high Fed funds rate for a longer period of time in order to let inflation gradually get down to the limits that the Fed would like to put on inflation. What that means is it continues to be more expensive for businesses to borrow money. It continues to be more expensive for lenders to get the capital they need to do their business. It's going to keep mortgage rates higher for people looking to buy and sell houses. And the cost of credit just gets exponentially higher for the average consumer. As the Fed funds rate has gone up, we've seen credit card interest rates for new cards get upwards of 25 and 30%. So we have an all-time record high in terms of consumer credit card debt, about $1.2 trillion at a time when interest rates are 25 and 30%. And that used to be the kind of interest rate you get from a loan shark, somebody who'd break your knees if you didn't make your payments on time. And now apparently it's not only okay, but it's the new normal. So that's what this higher for longer scenario really implies is a relatively high cost of living, very high credit costs for everybody from consumers to financial institutions. And that's all intended to slow the economy down a little bit so that inflation gets back under control.
I'm interested to see where the credit card debt, how that affects our intro to fix and flip type of investor, because we see a lot of investors getting started by using their credit cards, and a lot of seasoned investors will just churn through their credit cards to, they'll use their funds to pay for the rehabs, and then they'll just pay off their cards with a cash out refi and do it all over again. So, having a lender as a partner for the fix and flip properties that you're doing is such a great strategy to keep your credit score more stable and not be having that constant fluctuation. Where's your credit score going to be for the cash out refi that you're doing? If you've been using all of your credit cards for the rehabs, that may not be the best strategy right now, especially with interest rates being so high on the credit cards. You're much better off getting a fix and flip loan and using those rehab funds to fund the project instead of trying to use your credit cards and then just pay them off with a cash out refi. So, I hope that some of our kind of more seasoned investors take that to heart and, consider working with a lending partner on some of those fix and flip deals where they could fund them themselves, but maybe working with a lending partner is a better option right now based on the interest rates.
Yeah, if I were an investor right now looking at the choice between taking out a fix and flip loan at 9, 10, 11, 12%, depending on what my track record is and how creditworthy I am as a borrower, or putting those costs on a credit card at 25, 27, 29, 30%. The numbers actually tell a pretty compelling story. We're just talking about basic math here. Now, maybe that investor is trying to rack up points on their credit card for a trip to Bali next year. We don't know that. But your point's absolutely valid. In today's market, if you can take out a loan, even at higher financing rates that we see compared to a couple of years ago, it's far preferential to racking up a lot higher interest rates on that credit card. So it really is a much better strategy for most investors. In fact, one of the things we haven't talked about recently, but it does make me wonder a little bit is I mentioned that credit card debt is at an all-time high. We're up around $1.2, $1.3 trillion. with interest rates at 25, 30%. But we also have a record high amount of homeowner equity across the country, $32 trillion. And I do wonder a little bit why we're not seeing a little bit more activity in home equity loans, home equity lines of credit, where people could take out a loan at a 8 or 9% interest rate, pay down that higher credit card debt, and maybe even accrue some tax benefits in the process. But in fact, we've seen home equity lines of credit issued go down for 3 consecutive quarters now. So I think people are reluctant to tap into their house as an ATM, but it does make me wonder a little bit if these people are paying close attention to how much they're spending on their credit cards.
One of the questions that we see a lot is availability of products, availability of things that will help investors in the marketplace. And sort of dovetailing off what you're saying there about the home equity loans, what are you seeing from local traditional banks as to the availability of that product in the marketplace today?
Yeah, another great question, Jeff. The truth of the matter when it comes to home equity lines of credit is that they're not usually available from your typical mortgage lender. So if you look at some of the bigger lenders in the market today, they're non-bank lenders. They're companies like Rocket, like Loan Depot, like CMG Finance, New American Funding. These are all lenders who really focus almost exclusively on mortgages. A home equity line of credit is something a lender will keep on their books, in their portfolio, and those non-bank lenders typically don't keep anything on their portfolio. They sell those assets off in order to recapitalize so they can make more loans. So typically, home equity loans are issued either by large depository banks like Bank of America, or small community banks and credit unions who use those lines of credit kind of as relationship products for their members and their customers. And that's still true today. If you look at the top 10 home equity line of credit lenders, probably 5 or 6 of them are depository banks. But then if you look at the top 100, virtually everybody else is a small community bank or a credit union. And those are the kind of lending institutions that typically do most of the home equity line of credit lending. And it's a great product for them, and it's a great relationship tool for them and their customers or members.
Christine, I want to go back to some of the things we've been talking about expense-wise. When you're talking to customers, whether it be about pricing out deals, rates, leverages, but more importantly, expenses that are going to go into pricing out these deals, such as we talked about insurance, a big topic today. Also, the pricing of the actual rehab, all the expenses that go into the rehab,
Right.
and what level of rehab they're going to be doing on the product today. How are the customers thinking about that when it comes to return on investment?
Sure. So, I mean, right now I'm working with a lot of seasoned investors, so they're pretty good at penciling out these deals and making sure that they're not over leveraging themselves on the front end. So if the rehab is kind of light, a lot of seasoned investors will kind of be like, 10,000 for the kitchen, and it may cost 15,000. Maybe they're going to do it out of pocket. It's really important to make sure you're tight on those costs so that you're not over leveraging yourself on these bridge loans, because, while we are hoping that housing values come up in the next couple of months, call it 6 to 8 months, they may not come up as quickly as we're hoping. So making sure that you have a really solid exit plan for getting out of these bridge loans is really important. You don't want to be stuck in those for too long. Our goal is always for you to get the project done as quickly as possible, get it rented or get it sold, so you're not holding that property for too long.
Rick, when it comes to thinking about how inflation is still rearing its head in commodities that go into these rehabs, what's the data showing this year?
Interestingly, Jeff, the data is showing that the cost of repairs and remodeling for residential properties is continuing to go up. It's going up at a slightly higher pace than the rate of inflation, about 4%, maybe 4.5%. If you look at it from a slightly longer term perspective, if you look at it over, say, the last decade, those prices have gone up by about 65%. So a big increase in terms of those repair costs. Now, Individual investors can kind of soften the blow a little bit depending on the quality, the grade, the fit and finish that they apply to a rehab project. Are they going to go for top of the line appliances and all the most expensive fixtures because they happen to be in a very well-heeled community doing a fix and flip? Or are they going to be looking for, kind of standard issue or even bargain materials, depending on the nature of the property and the nature of the neighborhood and the flip? But there's no question that we've continued to see the price of repairs, the cost of labor go up at rates that are higher than the level of inflation.
And how is the quality of those materials going to affect what they can charge for rent once the property is ready? Being in tune with how much the market will allow for. If you're upgrading it to a quality where you're expecting that you're going to get, $2,500 for rent, but everything in your market is sitting at $1,500, was it really worth spending that much on the materials?
Yeah, important for an investor going into a market, going into a neighborhood, to know what the fit and finish, what the level, the caliber of everything going on within that house is, in order to maximize their return. And maximizing the return doesn't necessarily mean getting the absolute highest price for rent. It could mean getting the best ratio of rent to the expenditure that you put into acquiring that asset. So I've worked with one investor over the years who always likes his rental properties to be the nicest house in the neighborhood, but he's very quick to point out that they're only the nicest by this much. So he's not overshooting just for the sake of having the fanciest property in the neighborhood.
It's a great point.
So let's transition now and talk a little bit about the broader economy, where we are with certainly unemployment, as it really has a big effect on our rental customers. We need a healthy economy in the United States for our seasoned, especially serial investors who are aggregating single family homes that they know have stable families to move into these homes, who have good paying jobs for the long term. And as we think about recession and soft landing and all of these other buzzwords that we hear all the time, Rick, what can we tell investors today about the state of the economy and where we're heading?
Just about every economist that I've spoken with in the last few months has shifted the story from likelihood of a recession to probability of a soft landing. And that sounds like a big deal. I'm here to say it maybe isn't quite as big a deal as we think it is. The very strong likelihood is if we had a recession, even if we still do have a recession, it's very likely to be a very short and relatively mild recession, because all the other elements of the economy outside of what the Fed is doing with the Fed funds rate are actually performing very, very well. If we have a soft landing instead of a recession, it's going to be very close to the same sort of feeling as we would have gotten if we'd had a mild and short recession. And what that'll look like is the GDP, the gross domestic product, will slow down. We'll see fewer jobs available. We'll see fewer new jobs created. We'll see unemployment tick up a little bit. We'll probably see wage growth slow down. And those are all attributes that we would normally see in a recession. And it's going to feel very similar if, instead of a recession, we actually wind up with what economists would refer to as a soft landing. I can point out that the first quarter of this year, the GDP has come in at a number lower than most economic forecasts. Most forecasters were expecting the GDP to grow between 2 and 2.5%. And the numbers so far show that it came in at about 1.6%. So it does feel like consumer spending is slowing down a little bit, especially in certain categories. It does feel like the overall economy is starting to slow down, which again was part of the Federal Reserve's initiative. And so it wouldn't be at all a surprise if we do start to see wage growth slow down, unemployment tick up a little bit, and move more into that kind of soft landing, light recession mode that we've been talking about.
And when investors think about recession, no recession, I would think there's a lot of other factors at play that investors probably speak with you about and just sort of block out the noise, right? Like, so they think about, is the area that I am going to buy this house have more people living in it next year than they do today?
Mhm.
And if that's the case, the likelihood of me renting this home to a family is a greater possibility.
Sure.
What do people say when they're thinking about different areas that they're buying these rental properties?
Sure. So a lot of the investors that I'm talking with want to make sure that the house that they're purchasing is really middle of the road. They want to make sure they're not getting the most expensive house in the neighborhood, and they're wanting to make sure that the rehab isn't too heavy of a lift if that's the strategy they're going with. So they really are making sure that they are positive about what they can charge for rent. I'm seeing a lot more investors really hone in on the market rents for that area before they purchase the property, whereas sometimes in the past, we've seen a lot of fix and flippers just focus on the ROI for those properties and how much they can get out of the property. Now I'm seeing a lot more of our, DSCR repeat customers focused on what the long-term strategy is with these properties. They're seeing how much the values on these properties are appreciating, and they want to make sure that they can capitalize on that appreciation.
Rick, I'd love you to jump in on that topic.
Yeah, it's a really important consideration for investors, not just today, but always, but maybe particularly today. We've been telling investors, really, Jeff, for as long as we've been doing these updates, that local market conditions certainly trump anything you see in the national headlines. And I tend to look at things like population growth or decline, like job growth or decline, like wage growth or decline. And if you happen to be in a market where population is growing, there's more jobs than there were last year, and wages are going up, it's likely to be a very good housing market. I guess I'd layer on top of that, Jeff, the notion that affordability for prospective home buyers is probably at an all-time low right now. Home prices have continued to go up 6-7% year over year, and mortgage rates have not come down. They're still holding steady between 7-7.5%. So for a lot of prospective home buyers, they simply can't afford to buy a property right now. That's put a damper on flipping activity, because that buyer who might have bought your flip for $400,000 2 years ago can only afford $200,000 today because of financing costs. And the same sort of holds true for the rental market, but there is an opportunity in that bad news, which is that if you have the largest cohort of young adults between the ages of 29 and 35 in the history of the country, which we do today, those are prime years for household formation. And if those people can't afford to buy a house, they're looking to rent something. And so I do think, while affordability remains a real challenge for so many prospective home buyers, that's going to provide literally millions of opportunities for people to rent properties out to these folks who otherwise might have bought a property.
Yeah, for the millennials and the first wave of Gen Z that are looking to purchase their first home, we've been seeing some trends where they're looking to buy something smaller, not just because of the cost, but there's this shift away from having these, giant houses that were once the norm for, what you expected to be for your first house as a family. And now we're starting to see more comfortability with, 1,000 to 2,000 square foot homes. So I'm curious to see how that's going to impact our fix and flip investors and what properties they're targeting, not just for renting, but for flips and making it more of a starter home for this new wave of buyers that we're seeing ready to invest in real estate.
That's a huge trend in the market right now, in the housing market, and we continue to see people migrate from more expensive housing markets to less expensive housing markets. One of the reasons home prices are going up rather than down is because people are moving out of really expensive markets into less expensive markets, and aren't at all hesitant to pay top dollar, or maybe even over market values for the houses they buy in those less expensive markets. So those younger adults who have maybe the opportunity to work from home, or are able to find new jobs in those less expensive markets, are certainly creating opportunities for flippers in those markets that are in, say, the middle of the country, the Midwest, the Southeast, other parts across the South, where home values are more affordable. The challenge for a lot of flippers, though, candidly, is that if you look at the findings we get from the RCN Investor Sentiment Survey, what you're finding is that the overwhelming majority of flippers flip properties in their own town, in towns adjacent to where they live, and certainly, for the most part, in towns in their own state. It makes it really difficult for a flipper who's based in California to be managing that project, doing the construction rehab work on a property in Nebraska. And so while the opportunities are popping up where the population is moving, it's very often a challenge for those flippers to move with the population.
As we're talking about opportunities across the country, we've certainly mentioned over the past few months the Boise's and the Austins. But earlier on in our conversation, you mentioned Punta Gorda, which is on, for folks who don't know, it's on the west coast of Florida, and somewhat of a vacation area, but also an area with a ton of workforce housing, a real stable community. What are we seeing in the state of Florida, and what's changing?
We're seeing a few things happen in Florida, Jeff. For the last couple of years, Florida has been the location for people looking to relocate. We've seen massive population growth and home sales and home price growth in the state. Number one state in terms of people moving in, number one state in terms of out-of-state investors investing in real estate. There are parts of Florida that probably overshot the mark a little bit. Punta Gorda is probably one of them, where prices got out in excess of what the market could really bear long term. So much like we saw in Austin, much like we saw in Boise, there's a bit of a clawback now, and we see prices retrenching a little bit. But we're also seeing a couple other things. For the first time in a number of years, we're actually seeing population exiting South Florida. Now, the central and northern part of the state, we're still seeing population growth. But the more expensive region, the Miami region, parts of southern Florida, we are seeing a little bit of an exit from that part of the state, either out of state or to less expensive parts of the state. And the other thing that we're seeing, and this is also true to a slightly lesser degree in California and Florida or Texas, is we're seeing a lot of inventory coming to market in the state of Florida, a lot of housing inventory. And what that will do over time is start to slow down home price appreciation, and maybe even in some cases start to make properties cost less than they did last year because there's more inventory, more supply relative to the demand in the state. So lots of stuff going on in the Sunshine State right now that might change the dynamics in that market for a while.
Well, certainly Florida for RCN is a huge marketplace for us. And any sort of good news about prices possibly coming down to give investors a window, that's certainly great news.
Definitely.
If you're looking at parts of Florida to possibly see some price declines, it is looking like it might be in the south, the Miami region. Although a lot of those declines are likely to be in the condo market, which is probably oversaturated a bit. And we have seen some indication of a little bit of weakness on the western coast of the state. That could just be because prices overshot the mark there. But we were talking about this earlier. The thing that investors have to be cognizant of if they're going to be in Florida is the cost of insurance and the limited availability in some parts of the state to even get insurance from a third-party carrier. If insurance rates go up too high, that's going to limit your ability to either charge a rent as high as you might like, or to secure as high a purchase price for that property as you might otherwise have done. So make sure if you're investing in Florida, that you are doing a thorough assessment of what insurance costs are going to be in the market that you're looking at.
Rick, are there any determining factors on state-specific areas where insurance just becomes a vacuum where you can't get it? Like, how does that work?
We're seeing more trouble with insurance being unavailable in states like California than we are in states like Florida or Texas or even Louisiana, where insurance is available but at a high premium if you happen to be in one of the flood zones there. And sometimes it feels like the whole state of Louisiana is a flood zone. But if you're in parts of California that have been prone to wildfire over the last few years, the regulatory environment in California has been so strict for insurance companies that a lot of them have just opted to pull out of the state. That limits the number of carriers who are available to write insurance. And the insurers that remain are either jacking the prices up exponentially if they can in the regulatory environment, or they're opting just not to write insurance policies in those regions. So again, I think that's probably been the most dramatic example of insurance unavailability has been in some of the wildfire prone areas of the state of California. A little bit of that in Florida, in some of the areas that are more prone to hurricanes and floods, and likely something we're going to see more of as time goes on across the country.
Well, Christine, we're just about out of time. I think what we need to do is pin Rick down on what the interest rates are going to be at the end of the year.
I want it recorded so that if it's not true, we can come back to Rick.
So Rick, with all of your wisdom, where are rates going to be in the next 6 months?
With the caveat that just about every time I predicted mortgage rates more than like next Tuesday, I've been wrong. And everybody else has been too. I'm just the only one upfront about it. What I see is a market where mortgage rates don't come down significantly until the Fed announces its first rate cut. And they're not likely to do that until the end of the year. So really, for the rest of this year, I would expect mortgage rates for a 30-year fixed rate loan to kind of bounce back and forth in a very narrow band between about 7% and about 7.5%, sometimes a little higher, sometimes a little lower. The economists at Fannie Mae in their last forecast predicted that mortgage rates would end the year right at around 6.9%. That was significantly higher than what they had forecast previously. And it was basically because it appeared that the Fed wasn't going to be able to reduce the Fed funds rate anytime soon. So if you're looking for a number, you can pin me down at about 6.97%. I do think 2025 holds out much more hope for those mortgage rates coming down more significantly, slowly but steadily. But for the rest of this year, I think we're in that narrow band right around 7%.
You got the inside scoop for the investors, Christine.
Perfect. Yeah, my takeaways here are don't wait to start investing. I mean, we can't say for sure where those interest rates are going to be. You know, the biggest takeaways are always going to be stick to the basics, you know your market and know what's going on with the economy overall. But, make sure your deals are penciling out and then just go for it.
Love it. Rick, thanks so much for joining. Christine, thank you for joining me.
Thank you for having me.
Appreciate it.